Hi, and welcome to the Refinitiv Perspectives Live 24-hour special. This hour, we want to dive into the economic and investment outlook for 2021 with guest Bob Jenkins, who is Global Head of Research, Wealth Management for Refinitiv Lipper. So we'll welcome Bob Jenkins.
Hi, Caroline. Thanks for having me.
Of course. So first, to start out, this is going to be a look at 2021. So what are your views on equity markets in 2021?
Sure. We had just such an amazing 2020 where we saw really one of the sharpest drops and snapbacks we've ever seen. When you go back to the history of the markets, it was just incredible. And a lot of that was because I think the drivers that took us down in the first place were somewhat different. They weren't financial or economic. They were more emotional at the end of the day, if you will. People reacting, if you will, kind of emotionally to what was going on with the pandemic. And then, we had that stimulus coming in from the Fed and other central bank policy around the world, just kind of created that backstop and just snapped it again right back up. And that was really, to hate to use this word again, unprecedented, but it was incredibly unprecedented. But there are also a lot of drivers underneath that as well. And will they be able to kind of hang on and keep us going in through 2021? I think at a high level, personally, I feel like we're going to see a little bit more muted equity returns going through 2021 this year. A lot of the tailwinds that we have with the pandemic, particularly the continued stimulus that we will see more of, we have seen more of here in the US. We're going to probably see again that continued kind of accommodating stance by various central banks as we continue to push through the first half of 2021, and that'll keep equity markets propped up. Another one of the, I think, occurrences that happened in 2020 that has helped prop it up is the emergence of the retail trader. So we have a lot of folks now working from home. They have a little bit more time on their hands. Maybe they're multitasking while they're doing things like this. On the side, they're trading. And the retail trade volume really ticked up quite a bit. And apps such as Robinhood, which is essentially almost a video game where confetti showers down on you when you buy something, and it's constantly prodding you to do something else. And a lot of people kind of picked up the trading bug for the first time and started buying. And they started buying stocks, they started buying options. And when you buy options on stocks, you force essentially more stock buying in high magnitudes, and things like Tesla and other, as we call them now, the fan mags, your Facebooks, your Apples, your Netflix, your Microsoft, your Alphabets, et cetera, your Google. All these have been just kind of rushed into by the retail crowd. And that's created, again, that kind of self-perpetuating upward rising spiral of equity prices. So I think what we're going to see is a little bit of a curbing back of big tech as we move into 2021. Just because it's already it's a bubble kind of waiting a little bit to be deflated to a degree, but also the value names are just looking so good right now. And when you actually have an economy start to rebound, truly rebound, when people start going back to work, value stocks generally are the ones that get impacted positively right out of the gate. Your materials, your industrials, and I'd like to say some of the new entrants into the value space, like your leisure and your entertainment stocks, they'll all start to kind of enjoy that upward rise. And so you might see a shift in leadership for the first time in years, because growth has been leading the markets for years. And it's been kind of the tech story. You could see that shift in leadership. We've already seen it a little bit. We've seen, quite frankly, energy doing very well in Q4 after being miserable for most of the rest of 2020 and doing pretty well starting off here in 2021. So we're kind of seeing that kind of move back in. And a lot of the dividends in these value stocks are extraordinarily attractive right now. And we know that rates are generally very low in the fixed income space. So all in all, I think we're going to be muted. We had, globally, we had good returns this year. I think emerging markets are still going to do pretty well in 2021. But some of the more developed markets, I think, are going to pull back a little bit, and probably more in the, upper single digits, perhaps low double digits if we're lucky.
That's great. How about, can you talk a little bit more about the fixed income market rates and inflation?
Sure. I mean, obviously all kind of combined in a sense, they all impact each other, right? So fixed income, if you've been watching the markets, it has been overachieving for years. Every year, several economists go down swinging when they say this is going to be the year that fixed income finally falls on its face, and it never does. And I've personally been a proponent for many years now that there's really a good reason why it doesn't. For some time, I had the stewardship of a pension fund, so I oversaw how basically how pension funds offset the liabilities that they owe. And generally what they love to do is hedge that off with fixed income. And if you think about globally across the developed markets in the US and Europe and Asia, it's basically an aging demographic, and an aging demographic all really want to have income. And so they're seeking that income through annuities, through their pensions and such. And so therefore, there's this constant kind of, if you will, backstop of demand for fixed income, it allows it to kind of continue to roll along. However, it really, the buying, of course, is the panic buying that took place a little bit, in the snapback period in the markets was, kind of helped prop up fixed income quite a bit over the course of 2020. But I see that kind of winding back a little bit. Rightly so, I think, when you look at the municipal bond market here in the US, as well as broadly corporate bonds, they went crazy on issuing new paper over the course of the year of 2020. And it makes sense with rates as they were. They were trying to capture those rates, maybe extend out the debts a little bit. And in general, that kind of supply coming into the space is going to be difficult to continue to have solid returns if you got so much supply. And if you think about the Fed eventually perhaps pulling away the punch bowl, as it were, again, maybe sometime in Q3, if we're really seeing efficacy with vaccines and such and seeing the economy start to come back, that could, in fact, be a bit of a headwind for bonds and allow rates to come up a little bit. And again, as I was saying, rates, inflation, they all kind of tie together a little bit. And it's at that scenario where you can see rates coming back up. And when I was first thinking through what 2021 would look like about 2 months ago, I was thinking this would be the case. It already has been the case. We've seen the 10-year come up well over 1% right now. I think it has a little more room to go. It could find itself at 1.3, 1.5. So there's probably still a bit more room there. And when you have really all this stimulus kind of floating around in the system, building up in bank accounts and such, and you have all this pent up, consumer demand out there. So if you think about these forces at work and people starting perhaps to get back to work, and perhaps some of the industries that have been shuttered or scaled back are now starting to come back online, and people are starting to buy again. Now, keep in mind, when they start buying again, a lot of things that they used to buy, these industries have scaled back. So there is a clashing of kind of supply and demand right there, and that should hopefully bring in, I think, healthy inflation. We know the Fed here in the U.S. is actually encouraging it. They've come right out and made it 100% clear. They want to see a little bit more. It would be very helpful, of course, also for businesses to kind of enjoy that, and also for workers to enjoy some increased wages. So I think overall across the board, we're going to see a little bit more, if you will, muted returns in the fixed income space, but still positive. I'm certainly not calling that we're going to have a negative, reversal, if you will, in the fixed income space. We're going to still see that kind of ongoing strength in the fixed income markets. I just don't think it's going to be as strong as last year. And I think we're going to see rates popping up a little bit more, but not crazy. And I do think we're going to see some healthy inflation coming into the markets. And again, this is really, I think, quite welcome.
From where we've been going.
I think we lost Caroline.
Oh, back again.
He's a spinning wheel.
All right, so the next question we have is, you talk a lot about government intervention and how this can affect the markets. What are your views on areas where Biden and the slightly blue congressional wave might bring about your course changes from where we've been going?
Sure, I think, one of the nice things is the market's pretty much priced in a Biden victory some time ago, long before the disagreements we had 2 weeks ago, for sure. But certainly into the fall, when the polling was taking place, for once the polls actually were correct, almost spot on. So the market kind of took that into account already, and we can see today, of course, he has been inaugurated about 2 hours ago now, and the markets are doing well today. They've been doing well all year. So there's the markets, I think, are reacting well. I think in a lot of ways they're pleased with this change, but there will be some areas that are going to be impacted. Absolutely. He comes in with an agenda, a team really focused on the environment in particular. So if you think about ESG investing, ESG funds, and this space and the environment. And you think about oil, which is all tied in, energy prices all tied kind of in together. Absolutely, there's going to be some impact there. He's not necessarily a huge fan of fracking. He hasn't put together any specific policies against it per se, but I don't think there's going to be a warm embrace of it. We had, for instance, the Keystone pipeline project coming down from Canada into the mid and southwest, which had been, pushed forward, if you will, by the last administration. Very likely it will receive an executive order to shut it down straight away. So these two particular things and just that kind of general mood and tenor around oil production here in the U.S. Could lead to higher oil prices. And again, this is something I was talking about 2 months ago when I first talked about these predictions. We've seen oil come up. We've seen WTI, which is the price, the benchmark price for crude, West Texas Intermediate, coming into the 50s. Normally, it finds a lot of headwinds when it starts to head into the 70s area because of fracking starts to become profitable and starts to come online. But I think if we see less chance of that coming online in such a robust fashion, certainly we can see prices start to increase. We know that the other oil-producing nations are coordinating right now to try to pull in production, or at least keep pricing, not pull in production so much, but keep pricing in a stable space. So we're gonna see a lot of that. Joe Biden's also a fan of net zero by 2050. God bless him. That's a great thing to try to push for. He's looking for better ESG disclosure, which if you're in this space, if you've ever seen ESG data, you applaud that could possibly happen. So we're going to see, I think, again, oil going up, some more, essentially investments are going to come in the infrastructure space as well. And this is something he's been talking about quite a bit. And it's not just highways and airports and transportation, kind of the traditional infrastructure. I think one of the things he's mentioned many times is he'd like to try to pave the way for more electrification, if you will, what we call electrification of cars and automobiles, by putting in more infrastructure there, more charging stations. So you could see some investment in that space as well. Certainly, we're all prepared for taxes to rise. And, say what you will about the prior administration, the corporate tax cuts and the individual tax cuts did, in fact, stimulate the economy. They always do. It's a fairly logical relationship between taxes and economic stimulus. And so there will be a move afoot, I'm sure, to increase both. I think that, it's a tricky thing to do without putting a lot of brakes on the economy, particularly on the corporate side, quite frankly. I think he's targeting even higher income tiers on the individual side than, say, was the case with the Obama administration. But on the corporate side, it's a tricky thing to do because you might start having companies try to repatriate their headquarters somewhere else and start to move earnings offshore, and you don't want to see that. But so you will see, these sorts of things start to rise, and he's going to do some basic kind of actions probably within the first couple of days, and I think we're going to be very happy about getting back into the 2015 Paris Accord. He's going to be looking quite differently upon immigration. So depending on where you stand on that, he will be looking at these areas and likely making very quick changes. And these all tend to kind of ebb and flow a little bit in terms of how the markets react as well. And so if you see drastic kind of changes, again, to taxes, if you see drastic changes to even immigration, and if you see drastic changes, in oil prices, all these things could act as potential headwinds in the market coming forward. But that said, here we are. We've done well so far in 2021. It's been a nice kind of market environment across all asset classes, especially if you're in Bitcoin. It's really nice for you. And I think we're going to likely see that to continue, as I said, in a little bit more muted fashion. The big headwinds being, again, if we do not see the efficacy from the vaccines, and if we have great difficulty rolling them out, sticking arms, as they say, that could be a stumbling block, most definitely, for the economy. Let's just kind of keep our fingers crossed and hope for the best.
Of course. So, as you said, we've seen a lot of changes. There's still a little bit of uncertainty around different events and seeing how those are going to play out. But thank you so much for joining us today, and it's been such a great discussion. If you enjoyed this episode, you can read a blog on investment trends in a post-COVID world by scanning the code or going to the link on the screen now. Make sure to stay tuned for the next episode on the hour. We're going to be talking all about cyber security and digital transformation. See you on the hour.